Welcome to Reverse Mortgage Radio, hosted by Legend's very own reverse mortgage professor, Bruce Simmons. You have so many options with a reverse mortgage, everyone has a different opinion, and the government keeps changing the rules. You need to hear from the first certified reverse mortgage professional in Colorado to specialize exclusively in reverse mortgages, one of few in the state with the letters CRMP after his name. Bruce has the specific training and education you need to understand what you're buying. Now, here's your host, Bruce Simmons.
Hello, and welcome to another episode of Reverse Mortgage Radio. Thank you so much for joining me today. My name is Bruce Simmons, and I am the Reverse Mortgage Manager with American Liberty Mortgage right here in Denver. Today, what we're going to do is we're going to talk about three of the biggest benefits from my customer's standpoint of the reverse mortgage, but we're also going to talk about three of the largest objections from my customer's standpoint. So we're going to talk about the pros and the cons together in one show. Imagine that. But before we can get there, I do like to tell you how you can contact me. My number is 303-467-7821. That's my direct line. It rings right to me. 303-467-7821. I have it forwarded to my cell phone when I'm out of the office, which is a lot of the time because I go meet my customers in their homes most of the time. You can also visit me online, though, at reversemortgageradio.net. reversemortgageradio.net. And now, too, you can get my podcast, the recording of this show, on different streaming platforms. I don't think we're on iTunes yet or whatever. I'm not big on this. My web guy handles all this stuff. But the Apple stuff, because I couldn't remember my Apple password and I couldn't get it set up. So it's on me. They wanted me. They want me. I'm waiting for them to give me a good price, though, right? No, it's all on me. I don't remember the exact password. I thought I did, and then I had to re-verify it, and then they started asking me personal questions, and I didn't answer those right, apparently. I didn't know it was such a secret to be able to get into their site. Anyways, feel free to listen online as well at reversemortgageradio.net or just find me on anything except Apple products. And today what we're going to do is we're going to be going through the pros and the cons of reverse mortgages. Before we can get there, though, I do need to make sure that you understand the basics of how reverse mortgages work. In a nutshell, reverse mortgages are most of the time, in Colorado, probably 97% of the time, they're FHA-insured loans. In some states like California, where the property values are even higher than Colorado, a lot of those are proprietary loans, which are not FHA-insured loans. So there's differences. And we do some proprietary loans here in Colorado, mainly for non-FHA approved condominiums. So if you're in a condominium and you do not, your condominium is not FHA approved, we can still possibly help you with a non-FHA insured reverse mortgage. Or if you've got a $1.5, $2, or $3 million home, we could still do a reverse mortgage on that. And those are typically proprietary too, because FHA caps the maximum value that we can use when we calculate how much we can loan you. They cap that maximum value at $1,149,800. So roughly $1,150,000, say. If your house is worth $2 million, we're going to base the amount we can loan to you on $1,149,800. That's why a lot of people do choose to do a proprietary program if they have these high-valued homes. But there aren't that many people in Colorado who have these high-valued homes who want a reverse mortgage. That's why I say about 96 or 97% are FHA-insured loans, because that's the most popular one. That's the one I typically discuss on the show. I've done programs in the past on the proprietary programs, and if you want to go to my website at reversemortgageradio.net, click in the upper right-hand corner for Reverse Mortgage Radio Show, and you can scroll through all the shows. I think it's been quite a while since I've done a proprietary reverse mortgage show, but they work very similar. There's just some nuances that are different between the two different programs. Call me if you happen to have a $2 million home or something and you want to discuss it, or you have an uninsured a non-FHA approved condominium. I'd be happy to talk with you about that, and we could discuss the pros and cons of that program for you. But today what we're doing is we're talking about FHA-insured reverse mortgages. That program is called the Home Equity Conversion Mortgage, or the acronym for that is HECM, what we like to call a HECM. HECM is a HECM, and that's the program that is the most popular. That loan is designed for people that are 62 and over. It allows you to convert a portion of the value of your home into money that you can spend. You're not taxed on that money either because it's considered loan proceeds. It's not income. So sometimes people will say, well, you can take a monthly income payment from a reverse mortgage. That's not actually correct because it's not income. You could take a monthly stipend or receive a monthly payment from the reverse mortgage, but it's not income. You can also set it up as a line of credit. There's a ton of benefits for that too. You can take the money as a lump sum also, or any combination of the three. So if you have an existing mortgage, this is one thing that's important to understand. Any existing loan that you have against the property must be paid off with the reverse mortgage or a combination of the reverse mortgage and other money that you might have. For example, let's say we could loan you $200,000 on a $500,000 home. Your home's worth $500,000. We can loan you $200,000. In that scenario, let's say if you owe $150,000 on the home, the first $150,000 out of that $200,000 has to go to pay off the existing loan on the home. The benefit to that is you get out from under the principal and interest mortgage payment because there's no payments required on a reverse mortgage. You still have to pay your own property taxes and homeowners insurance and maintain the home as you normally would. You have to use the home as your primary residence and keep your name on title. As long as you do those 5 things, there is no monthly payment required to the mortgage. What happens is because there's no mortgage payment, you're still charged interest. And I'm going to dig into both of those scenarios later in the show. But then what happens is your loan balance gets larger and larger over the life of the loan. And you have to be okay with that because the interest you're not paying on a monthly basis is added to the loan balance. However, once we pay off that existing loan you have on your home, there's no restrictions on what you do with the rest of the money. Now, there are possible restrictions on how you draw that money out, because if you said to me you wanted to pull all the money out in one lump sum and there's $50,000 left over, FHA has rules on the amount of money that you could pull out in the first 12 months of the loan. Typically, when you're paying off a mortgage that's beyond 60% of the amount of money available to you. So, for example, I'm probably digging myself a hole here because it's easier to explain if you're looking at numbers. If we could loan you $200,000, 60% of that $200,000 is $120,000. If you own the home free and clear and there's no outstanding mortgage at all on the house, then that you have that $200,000 available to you, but FHA says, nope, you cannot take all that $200,000 in one lump sum. You can only take 60% of it, which would be $120,000 in the first 12 months of the loan. You do not have to take that much money, but that's the maximum that you could take. In the case that I started out with earlier, where you owe $150,000, that's more than 60% of the loan. FHA allows us to loan you enough to pay off the existing mortgage on the home, even though it exceeds that 60% of the loan amount. But then you're limited on the amount of money that we can give you on top of that payoff to 10% of the loan amount. We call the loan amount basically the amount of money available to you. That's called the principal limit, okay? But you can take out an additional 10%. So if we are paying off a $150,000 loan on your home, you have $50,000 left over because the total amount available is $200,000. That means you only can take $20,000 beyond the payoff of the existing mortgage of $150,000. The other $30,000 that's available to you would be left in what's called a line of credit, or set aside in this line of credit, that would be available to you after a year time has elapsed from the closing date. So that money would be available to you later. You just don't have access to it today. Okay, so that's kind of they've got some weird restrictions on the actual lump sum draw. If you just wanted to say leave all the money in a line of credit and you had no mortgage on your home, that's fine. You could do that. And then throughout the year, you could tap into that $120,000 that's available to you, but you could not take the full $200,000 until 1 year has lapsed. So you could take up to $120,000 in the first year, and then the other $80,000 would be available to you after the first year. Or if you didn't take any in the first year at all, and you just wanted that line of credit available to you, you could do that. And then all $200,000 would be available to you after the first year. You could also receive a monthly payment. Let's say you wanted $1,000 a month. That's fine. After the first year, you've only pulled out $12,000, and you're nowhere near that $80,000 limit. Same thing, even if you took out the $150,000 to pay off the existing mortgage, and then you had $1,000 a month, that's only $12,000. You've got $20,000 available in that first year. All right, that's enough. I'm sorry. I got way, way, way too far into the weeds on that. Let's get to the topic of the day, the benefits of the reverse mortgage. The biggest benefit, we already mentioned, it's no mortgage payment required, no monthly required mortgage payment. That's the biggest benefit that people have on the reverse mortgage. Now, payments are optional. You can make payments on this, and I've got customers that do. In other words, let's say you're planning for your retirement, but you're not going to retire for a couple of years. You say, okay, I want to get out from under my mortgage payment so I could save more money. That's one option, but you could also say, I want the flexibility of making a mortgage payment or not making a mortgage payment. Let's say 1 month you want to take a trip and you're gone, and you don't want the obligation of making a mortgage payment. But then the next month you come back and you work twice as hard and you have 2 months worth of payments. You can apply that towards your loan balance. It's very, very flexible. Some people will make payments while they work. And what the benefits of that are is you're reducing your loan balance. Remember, because you're being charged interest every month. So if you pay that interest and even a little more, then your loan balance will go down. And every penny you put into that loan balance rolls over into money that's available in the line of credit. So over the course of the year, let's say you pay $12,000 that first year. You start out with a line of credit of $50,000. A year later, you would end up having $62,000 in the line of credit. Actually, you'd have more because the line of credit grows, but we'll touch on that in a few minutes. So that's the number one benefit, is no mortgage payment required. Most people do not make a mortgage payment. You've got this $1,000 principal and interest portion of your mortgage payment, and you just need to pay that off so you can retire. And that's great. That gives you $1,000 a month extra that you could do whatever you want with. You keep that monthly payment in your pocket. That's the benefit of the reverse mortgage in that case. The other benefit is there's something called, this is what's called a non-recourse loan. Remember I said how the loan balance grows over time? Well, it's possible, let's say you live in the home for 20 years and everything's going great. You never make a payment on the loan, but then at the end of this 20 years, you pass away. And you just happen to pass away at a time when the real estate market crashes by 50%. So you've had 20 years of interest accruing on this loan. So that $150,000 that you took out up front has now grown to say $300,000 or $350,000 or $400,000. And your house, it was worth $500,000, it went up maybe, but then it crashed back down to $350,000. So you owe $400,000 on the loan, but it's only worth $350,000. In that scenario, you're never going to pass a debt beyond the value of the home to your estate or your heirs. Normally what happens is, let's say You pass away, your heirs inherit the home, and it's worth $700,000. 300 or let's say 400 is owed on the reverse mortgage. Your heirs inherit the home. The bank does not take your home when you die. That's the biggest misconception people have. I'm going to repeat it. The bank does not automatically take your home when you die. They might take your home if, when your heirs inherit it, they don't do anything with it, and they decide they're taking their time, or they just mess around and don't sell the house or communicate with the lender. In that situation, the bank will foreclose on the house. But that's not their option. That's not their first option. They don't want the house. They just want to get paid off. So your heirs sell the house for $700,000, pay off the $400,000 that's owed, and they inherit the $300,000 difference. But if there's no equity left in the home, they could sign the house over to the lender and walk away. There's no recourse. The lender has no recourse on you, your estate, or the heirs. What happens in that situation is, let's say they sell the house for whatever they can get for it, and they lose $50,000. They file a claim with a mortgage insurance company, and the mortgage insurance pays the lender, not your heirs, but they pay the lender the amount that they would have lost otherwise. So the lender does not lose any money. Because the lender's not losing any money, they're not going to come after you, your estate, or your heirs for anything else. Now, if you've got a conventional mortgage and that same scenario happens, because this happened in 2008, where you end up upside down on the house and you pass away and you owe $300,000 and you are on the loan and the house is only worth $250,000, your heirs sign the house over to the lender and walk away. The lender will sell the house for whatever they can get for it, and then they could come back on your estate and file a claim against your estate, or they could do what's called a deficiency judgment. They get a deficiency judgment against your estate to where you might have $100,000 in the bank. They could attach that money and take their $50,000 that's owed. I think that's still the case. I know back in 2008, President Obama overruled that law for a while. He said no more, that you can't do that. And I don't know I think that's back in place now. It's called a deficiency judgment. And that can never, ever, ever happen with a reverse mortgage, with an FHA-insured reverse mortgage or a proprietary reverse mortgage for that matter. Neither one can do that. That's in the paperwork. It says that. So that's the other benefit too, non-recourse. Number one, benefit, no monthly mortgage payment. Number two, non-recourse. Number three, the line of credit that's available to you, if you leave money in the line of credit, it gets larger over time. Remember, I said if you made payments on that and you paid $12,000, you started off with a $50,000 line of credit and you paid $12,000. Now you've got $62,000 a year later in your line of credit. Oh, not actually, you'll have more than $62,000 because that line of credit will grow at 0.5% greater than the interest rate you're being charged on the loan balance. If you owe $150,000 on the reverse mortgage, and let's say you're being charged, let's just say 7% on that loan, your line of credit, that $50,000 is growing at 7.5%. So over the course of the year, if you didn't add any more money, that line of credit would grow by about $3,500, $3,700 gets added to the loan. So a year from now, instead of having $50,000, you'd have $53,700 roughly, give or take. And that compounds too. So it's if you make a payment $1,000, well that $1,000 that moved over to your line of credit is growing as well. One quick caveat, you are not earning interest on the line of credit. It's growing at a specific rate of growth, but what we're doing is we're increasing the amount of money you could borrow from the equity in your home. If you take that money, let's say you got your line of credit grew by $3,700 and you're like, hey, woohoo, I'm going to pull that money out and I'm going to spend it. That's fine. You can do that. And you're not taxed on it because it's not income. But then that $3,700 gets subtracted from the line of credit and it gets added to the loan balance. because now you're using that money. So now, just like a credit card, think of it like a credit card. If you had a $5,000 limit on your credit card, and the credit card company increased your line of credit by $3,700, and you use that $3,700, well, now you owe that $3,700 with interest back to the lender, back to the credit card company. Same thing with a reverse mortgage. The difference is you don't have to make a payment. Remember, number one. So the benefits are no required monthly payment, non-recourse loan. The lender can never come after you. Also, too, part of that non-recourse is that line of credit's 100% protected. In other words, let's say the property value drops and you still have $50,000 in the line of credit. The lender can never, ever, ever close that line of credit out as long as you live there as your primary residence, pay the property taxes, pay the insurance, maintain the home, and keep your name on title. Do those 5 things, and that line of credit will always be available to you. Or your spouse, if either one of you are living in the home. Both of you don't have to live in the home for that. And then the line of credit will grow also over time. All right, now let's touch on the objections. But before we do that, if you're just tuned in, my name is Bruce Simmons, and you are listening to Reverse Mortgage Radio, and we're talking about the pros and cons of reverse mortgages. My number, if you have any questions about this, about reverse mortgages, is 303-467-7821. 303-467-7821. Or you can visit me online at reversemortgageradio.net. I also have a YouTube channel. You can visit me on YouTube. I try to post some videos now and again. I'm on LinkedIn. If you're on LinkedIn, I think I have a Facebook page too, but my web guy posts stuff on that. I don't ever check it. I don't even know my password on that. Kind of like Apple, right? All right. But we're going to talk about the objections today. Let's go over the objections that customers have. Number one, closing costs. And now that goes back to the second benefit, because remember I said it's non-recourse? The reason this loan is non-recourse is because there's something called mortgage insurance protection or mortgage insurance premiums that are charged on the reverse mortgage. There's mortgage insurance, and that protects the lender. Remember I said how the lender gets paid if more is owed on the home than it's worth. That money comes from all the borrowers, everybody who takes out a reverse mortgage. They're charged an initial mortgage insurance premium, which is part of the closing costs. It's a one-time fee, and it's 2% of the value of the home up to the maximum claim amount, which is that $1,149,800 figure. So if you've got a $1,149,800 valued home, we're going to charge you 2% of that. Let's just use $1 million. So if you have $1 million home, you're going to be charged $20,000 in initial mortgage insurance premium. Then most people don't have $1 million homes. Let's say you've got a $600,000 home. That initial mortgage insurance premium will be $12,000, 2% of the value. You're also charged an ongoing mortgage insurance premium that's equal to 0.5% of the loan balance. If you have a loan balance, let's say you take out a loan, you have a $600,000 home, you only take out $100,000 up front, so your loan balance is $100,000. Over the course of the year, we will add roughly $500 to your loan balance because that mortgage insurance is collecting or being charged at the rate of 0.5% per year. It's charged monthly. So basically, we take 0.5% times 100,000 divided by 12, and that's 1 month. Then we take the next month, whatever the loan balance is, times 0.5% divided by 12, and that's month number 2. So that compounds over time too, just like the line of credit I mentioned. That's number one. The second negative factor, or the objection, is that negative amortization. Because you're not making payments on the loan, you're charged interest and mortgage insurance every month. We were just talking about that. That gets added to the loan balance. Every month, you're going to get a statement in the mail. You're going to see that balance getting bigger and bigger and bigger over time. Keep in mind, you have to be okay with that. If looking at that balance is going to cause you more stress than the benefit that you get from the reverse mortgage, do not do the reverse mortgage. Don't do it. It's not worth it. This loan is intended to relieve financial stress, not create it. And that's not my goal. I don't want you to feel stressed out because you have a reverse mortgage. Now, odds are the third negative is also a positive because we don't loan 100% of the value. We don't loan 80% of the value. We don't loan 70% of the value. We very seldom loan 60% of the value. The older you are, the more money you can get on a reverse mortgage. Also, the higher the interest rate, the less money we can loan. Because interest rates have gone up, we're loaning anywhere between 30 to roughly 60% of the value of the home. You've got to be in your close to 90 years old or older to get 60%. If you're, say, 62 years old, we're going to be loaning around 32% of the value of your home, 32, 33% of the value. If you have a $1 million home, that means we can loan you roughly about $320,000 or $330,000 on a reverse mortgage. And hopefully that would be enough to pay off the existing loan on your home. But you say, well, wait a minute, I've got like $500,000 equity in my home. We don't look at equity. We look at the value, and then we have to loan you enough to pay off the existing mortgage. Remember, we talked about that at the beginning. You have to pay off that existing loan that you have on the home. If you owe more on the home than what we could loan, you can make up the difference. Let's say that we could loan you $320,000, but your mortgage balance is $330,000. Well, your mortgage payment, if you have that big of a loan, might be $1,500 a month for principal and interest. Well, if you have to bring $10,000 to closing, you're going to get that $10,000 back in savings in what, about 5 months? 6 months. You're going to have 6 or 7 months. My math is not that great today. I apologize. But you're going to get that money back in savings in just a few months by bringing that $10,000 in to closing. So keep that in mind. That's a possibility. I have some customers that do that as well, just because we can't loan that much. So that's a negative. A lot of people say, well, I thought I was going to be able to get like 70 or 80% of the value. No, that's not how it works. You get roughly between 32 to 60% depending upon your age, given the interest rates the way they are today. So the negatives: upfront closing cost, negative amortization, meaning the loan balance grows, and the amount that we can loan is on the low side as a percentage of the value of the home. But that's also a benefit because you're going to have more equity available on your home. The pros are no required monthly mortgage payment. It's a non-recourse loan. The lender can never come back to you for anything you owe beyond the value of the home. And the line of credit, if you have money available in the line of credit, will grow over time. Thank you so much for listening. My name is Bruce Simmons. You can reach me directly if you have any questions at 303-467-7821, or you can visit me online. If you missed this show and you just tuned in, what you want to do is go to reversemortgageradio.net, reversemortgageradio.net, and click in the upper right-hand corner for Reverse Mortgage Radio. You can listen to the entire show. It'll be up on my radio show or on my website next week. Thanks so much for joining me today. I hope you have a fantastic day.
Call Bruce Simmons today. Ask about his free Colorado Consumer Guide, 303-467-7821 or reversemortgageradio.net. Bruce will come to you anywhere across the Front Range to make sure you understand how reverse mortgages work. Regulated by DORA, NMLS number 409914. American Liberty Mortgage is an equal housing lender.